Hello everyone, I'm Old Fish. The race for high-dividend ETFs in Canada has officially turned white-hot in 2025, with every issuer chasing higher and higher yields. In this competition, Hamilton's answer is the DayMAX Series. Back in July, they launched 3 ETFs, CDAY, SDAY, and QDAY, all utilizing a 0 DTE, or 0 days to expiration, option strategy. At launch, CDAY and SDAY targeted an annualized yield of 18%, and QDAY targeted 20%. Although these numbers might not match those 30% yield products currently on the market, I want to argue today that DayMAX has made a much more balanced choice in its structural design. Personally, I feel this is the most sincere product launch of 2025, and these are the 3 ETFs I will be watching most closely in 2026. So today, let's break down Hamilton's DayMAX series. First, let's look at what these 3 DayMAX ETFs actually invest in. CDAY invests in Canadian blue-chip stocks. Its underlying asset is Hamilton's own CMVP, the Canadian High-Dividend Index ETF. SDAY invests in U.S. large-cap blue chips. Its underlying asset is SMVP, which tracks the U.S. High-Dividend Index. The companies in these indices are basically blue chips with strong track records of paying and growing dividends. It is worth noting that both of these ETFs also hold an extra 25% position in VOO. QDAY invests in the tech sector of the S&P 500. Its underlying assets are XLK and QQQM. Now, let's talk about the structure. All 3 ETFs distribute income semi-monthly. That's twice a month. They carry mild leverage of 25%. And the management fee is 0.85%. But the key differentiator is the 0 DTE strategy. This means every single trading day, they sell call options that expire that same day. This option strategy covers the extra borrowed position. It is executed on the S&P 500 via VOO, or the NASDAQ 100 via QQQM. Think about it. A traditional covered call strategy operates 12 times a year. DayMAX sells calls every day, so that's about 250 times a year. Because of this higher frequency of collecting premiums, DayMAX didn't need to increase the covered call coverage to chase yield like its competitors. Instead, they chose a relatively conservative 25% coverage ratio. This design is exactly what I appreciate most. So what is 0 DT? It stands for 0 days to expiration. We often call it doomsday options. A traditional covered call strategy sells an option once a month, whereas 0 DT sells an option that expires today, every day. It's like switching from collecting rent once a month to collecting rent every single day, 250 times a year. Even though the daily premium is smaller than a monthly premium, when you accumulate it every day, the total is substantial. The biggest advantage of 0 DTE is that it preserves overnight exposure. A traditional monthly covered call locks in your upside for the entire month. If you sell a call at the start of the month, you miss out on all the gains above your strike price for that covered portion. But 0 DTE options expire every day at the closing bell. If the market explodes overnight, you capture 100% of those gains, and if there's good news before the opening bell the next day, you fully enjoy it. Historical data shows that a huge chunk of stock market returns actually happens overnight, and while traditional strategies miss this, 0 DTE does not. Beyond holding overnight exposure, 0 DTE offers daily flexibility because every day is a fresh start, allowing them to adjust the strategy based on the immediate market environment rather than being locked into a position for 30 days. Of course, 0 DTE has risks as it relies on daily execution, but because they only cover 25%, even if there are execution errors, the impact on the overall return is limited. And that leads me to my next point. The 25% covered call coverage is, in my opinion, the best part of DayMAX and the core reason why I think its structure is superior to many competitors. Note that this 25% is relative to the total leveraged exposure of 125%. Covering only 25% means you are only writing calls on 1/5 of your portfolio, while the remaining 100% of your position is completely free to run as high as the market goes. Some products on the market cover up to 50% just to chase a higher yield number. Why is 25% better? First, it strikes a balance between income and growth. The higher your coverage ratio, the more upside growth you sacrifice. By using a low coverage ratio, you generate a high yield thanks to the 0 DT frequency, while keeping roughly 80% of your total upside to capture long-term growth. But more importantly, it reduces the impact of human error. Covered call execution involves human judgment, and in extreme markets, errors are inevitable. But if you only cover the borrowed 25%, mathematically speaking, even if the strategy is executed poorly, it only affects 1/5 of the portfolio. The other 4/5 are unaffected and track the market normally. I think combining 25% coverage with 0 DTE is a very smart move because you trade frequency for space. You don't need to force a higher coverage ratio. You keep it low to let the frequency work for you while preserving most of the upside. That is DayMAX's biggest structural advantage. The core holdings of the DayMAX series are index tracking. CDAY and SDAY hold Hamilton's own high-dividend index ETFs, and QDAY holds XLK. These indices have clear selection rules based on market cap, liquidity, financial thresholds, and fixed rebalancing schedules. Why does this matter? Transparency. You know exactly what you are buying, and the holdings won't suddenly shift based on a manager's gut feeling. This reduces the risk of active stock picking. Active managers can be wrong, but index rules are objective, stable, and predictable. Even though DayMAX is new, the underlying indices they track have long histories, and combined with an understanding of the structure, we can reasonably predict how these three ETFs might perform in the future. I've praised DayMAX a lot, but does it have downsides? Of course it does. First, the elephant in the room. It's expensive. The management fee is 0.85%, which is definitely on the high end for covered call ETFs. Given the complexity of zero DTE, it's understandable, but there is a hidden cost people ignore: fee stacking. You are likely paying fees on the underlying ETFs too. For VOO, the MER is negligible, but for CDAY and SDAY, the underlying ETFs will start charging 0.19% in 2026. For QDAY, the underlying XLK charges 0.08% and QQQM charges 0.15%. This means the total management fee for SDAY is set to exceed 1%, and even QDAY will be hovering very close to 1%. This is quite steep. Secondly, the semi-annual rebalancing frequency concerns me. Because the VOO and QQQM portions are used specifically for writing covered calls, usually at the money, that specific covered portion gives up all upside and is constantly being decayed before the next rebalance. If we see a massive market drop within that 6-month window, it's hard to say if that portion can sustain the dividend. Of course, this doesn't mean the fund manager wouldn't step in during such a scenario to expand the covered call coverage to the main holdings. So, the problem remains controllable. One final note on taxes. For SDAY, since it holds US dividends, a small portion of its income is 100% taxable, whereas CDAY won't have this issue. My overall take on the DayMAX series is that it is a structurally sound product. In a race where yield is king, Hamilton chose a more balanced path. They used the frequency of zero DTE to boost income rather than forcing a high covered call coverage, stuck to index holdings rather than active picking, and kept a mild 25% coverage to balance cash flow and growth. Because the coverage is low, even human execution risks are contained, making DayMAX a better candidate for long-term holding compared to many competitors. It won't give you the absolute highest yield number on the screen, but it gives you a more robust structure. It's not cheap, but in my book, when evaluating high-dividend ETFs, I look at the underlying assets first, structure second, and fees last. Personally, because I am bullish on the AI and tech sector, I will be using QDAY as a supplement to my position in QQCL to diversify the risks associated with different covered call strategies. I hope this video helps you fully understand DayMAX and make the right decision. I'm Old Fish. If you like this content, please don't forget to like, comment, and subscribe. It really helps the channel. See you in the next one.